Plug Power dropped 3.7%. Lab scores at 48 out of 100. Hold. A 48-point lab rating currently signals weak cash conversion and uncertain demand scaling. Investors fear the nationwide green hydrogen plumbing plan stalls significantly without contracts. Our teardown shows why the first-mover myth crumbles and what catalyst could revive the play. Plug Power's hardware stack is currently a strategic liability because their reliance on PM, proton exchange membrane, a technology using solid polymer electrolytes to generate hydrogen, carries a 30% higher capital cost than the alkaline electrolyzers flooding the market from China. While PM offers better dynamic response for intermittent wind and solar, the physical reality is that iridium catalyst scarcity creates a hard floor on stack pricing that competitors do not face. We are looking at a system where the stack power density, the amount of energy generated per unit of volume, is superior, but the levelized cost of hydrogen remains uncompetitive without massive subsidies. Compared to fuel cell energy's molten carbonate systems, Plug is trapped in a high capex cycle where engineering excellence cannot overcome the raw physics of material costs. This engineering bottleneck is why we see the stock trading at $2.61, a 3.7% drop, while peers like Fuel Cell Energy surge. The market is realizing that superior membrane technology does not matter if you cannot hit a positive gross margin, the percentage of revenue exceeding the cost of production. With the 10-year yield at 4.51%, the cost of financing these high-density electrolyzer plants has effectively doubled since the project's inception. Investors are rotating out of Plug because the technical moat is being bypassed by good enough alkaline systems that scale faster and cheaper. Decline is not just volatility. It is a repricing of a hardware roadmap that has not accounted for the rising cost of capital and material constraints. Quarterly financials showing modest revenue momentum for Plug Power. By Q4 2026, the normalization of the yield spread, currently at plus 0.27%, will force a 15% contraction in Plug's valuation multiple as the era of cheap capital for green hydrogen infrastructure vanishes. The Fed's current 3.63% rate acts as a direct tax on Plug's R&D budget, which is fighting a losing battle against a 4.3% unemployment rate that keeps domestic labor costs for plant construction elevated. While revenue grew 22.3% year-over-year, that growth is being suffocated by a normalizing yield curve that prices in a rising recession risk. This macro friction makes the $1.66 billion Department of Energy loan guarantee a binary survival event rather than a growth catalyst. If that capital does not hit the balance sheet soon, the high beta nature of this stock will lead to further liquidation. The geopolitical landscape is shifting from global cooperation to sovereign resilience, and Plug is caught in the crossfire of renewed trade protectionism. As rumors of aggressive new tariffs on imported components circulate, Plug's exposure to international supply chains becomes a massive margin risk. The new Cold War dynamics mean that green hydrogen is no longer just a climate goal. It is a national security asset, but one that is being strangled by Section 45V tax credit rules, federal incentives that require strict proof of clean energy sourcing. This regulatory tightening, combined with the market's extreme fear sentiment at a level of 17, suggests that capital is fleeing high-risk industrials for the safety of defense stocks. Plug is not just fighting physics. It is fighting a geopolitical pivot toward isolationism. Plug Power is trading below its 20-day average, currently at $2.61. Management's headline, Liquidity-Focused Tax Credit Sale Update. That phrase appears in every press release for the last 30 days. 3 words designed to make investors feel the balance sheet is secure, while steering attention away from the fact that the company is selling future tax assets just to fund current operations. It's not growth capital, it's survival cash. Insiders have net sold 50,000 shares in the past 90 days. No named executives, just the pattern. Historically, that precedes a margin reset or a capital raise. The stock is down 12% since the last 8K, and the short volume ratio is flat to baseline, meaning the move isn't short-driven. What's driving it is the gap between the glossy Danish electrolyzer deployment and the reality that R&D spend dropped 25% year-over-year from 11% of revenue to 8.2%. That's not efficiency, that's pipeline starvation. Management talked about record demand. The phrase is normalizing inventory. That's not a synonym, it's a margin warning. The Q&A is where the real story leaks. When an analyst asked about gross margin trajectory, the CFO pivoted to "We don't provide quarterly guidance." That's not confidence, that's a hedge. Institutional holders like BlackRock added 30%, but ARK trimmed the same week the tax credit sale was announced. Divergence is the tell. What management is saying is liquidity. What the lab hears is we are one CapEx cycle away from a dilutive raise. Watch for R&D as a percentage of revenue to drop below 7% in the next 10Q. If it does, the turnaround thesis is dead. The momentum breakdown for Plug Power. RSI sits at 15, pointing to oversold territory, potentially setting up a bounce. MACD is currently bearish, with downward histogram pressure. The bull case for Plug Power rests on its first-mover advantage in building a nationwide green hydrogen plumbing system. Their PM electrolyzers offer the highest power density in the industry, making them the only viable choice for space-constrained industrial sites. If the Department of Energy finalizes the $1.66 billion loan guarantee, the liquidity crisis evaporates instantly. But here is what breaks the bull thesis. The market has zero trust in management's ability to execute without further dilution. The act of issuing more shares which reduces the value of existing holdings. With a massive 28.1% short interest, the smart money is betting on a total collapse of the 45V tax credit framework. Technicals confirm this, with price trapped below the 200-day moving average of $3.10. The question that stops the room: at what point does the cost of iridium and platinum catalysts make PM technology a permanent laboratory curiosity rather than a commercial reality? The lab's answer is that the engineering limit is already here. Unless Plug can reduce catalyst loading by 40% in the next 12 months, they will continue to lose every competitive bid to cheaper, more durable alkaline systems from overseas. Engineering superiority means nothing if the unit economics do not close. If Plug secures the DOE loan by Q3 2026, expect a squeeze toward the $4.14 resistance level as shorts cover. If the loan is delayed or the 45V rules remain restrictive, the stock likely tests the $1.09 annual low. The lab's call. With an AI score of 48 and bearish momentum, the downside risk outweighs the oversold bounce potential. Watch the $2.61 support level closely. Here's the macro picture shaping Plug Power. High interest rates under current Fed policy make building massive green hydrogen plants much more expensive because these projects require huge upfront loans. Meanwhile, the strict Section 45V tax credit rules mean Plug must prove their power comes from new clean sources, which slows down their ability to collect federal subsidies. Plug is building a massive green hydrogen network that functions like a nationwide plumbing system for clean energy to replace diesel in heavy machinery. They face intense pressure from cheaper alkaline electrolyzer competitors in China and Europe who are trying to undercut Plug's more advanced but costlier membrane technology. The biggest boost would be the Department of Energy finalizing a $1.66 billion loan guarantee, which would provide the cash needed to finish their delayed production facilities. Conversely, the main risk is another cash shortage that forces the company to sell more discounted stock, further lowering the value for current shareholders. Plug Power missed earnings forecasts, yet its hydrogen backlog surged. Where do you see Plug in 30 days? Up, down, or flat? Drop your call. This commentary is for educational purposes only and does not constitute financial advice. You should conduct your own due diligence. And remember that past performance is not indicative of future results. Investing always carries risk, and you must evaluate all factors before acting. If you want our full breakdown on Intel, the link is in the description.